What happens when a company sells to customers before collecting cash? In this video, I explain how accounts receivables are recorded, why we estimate expected losses, and how bad debt expense, allowance for uncollectible, and write-offs impact the financial statements. What are accounts receivable? These are assets that reflect the amounts that customers owe to the firm for the delivery of goods and services. So the job has already been done, but the customer hasn't paid. That creates an accounts receivable. Do we want to have accounts receivable? Well, I think we can agree that everybody would prefer to be immediately paid in cash in all situations. However, why do we have accounts receivable? The benefits of having accounts receivable is that you're going to be able to make sales to customers who are unable or unwilling to pay cash. What is the cost of allowing your customers credit? Number one, you have a delay in payment. Instead of collecting the cash immediately, you're essentially financing their operations for a time. It could be as short as a 15 or 30-day invoice, or it could be longer. You could be waiting 60, 90, 180 days, etc., depending on what's normal in your business, what's normal in your industry. Cost number two is the logistical cost. You now need to have the support system in place for administration and collection of accounts receivable. Cost number three, and the one that we're really going to focus on in this video, is that you may not be able to collect all of these accounts receivable. So you now have a risk of granting credit to bad customers and ultimately not be able to collect the assets that are due to you for the work that has been performed. Let's refresh our understanding of how we record accounts receivable. And on this channel, we do not talk about debits and credits. We stay away from bookkeeping. We always think about how a specific transaction ultimately impacts the financial statement of a company for the period that that transaction occurs. Let's talk about a firm making a credit sale. If you are a firm and if you have done your job, if you have provided the service or provided the good that constitutes your line of business, then even if you do not get paid immediately, you get to record revenues. In terms of the impact on the income statement, the credit sale is going to increase our revenues, and of course, this increases our profitability as well. Now, anytime we have an increase in profitability, mechanically, we think of that as increasing our retained earnings, which is an equity account on the balance sheet. And again, here, I'm abstracting from the nuances of whether things are recorded in the middle of the quarter or whether things are recorded during the closing process. The bottom line, the important part is that when you make a credit sale for the period, for the quarter in which you make the sale, you have the impact on the revenues, you have the impact on profit, you have the impact on retained earnings. And at the same time, you have not collected the cash, but you have created an account receivable. So here I'm going to call this the gross accounts receivable, even though that's not a language you're going to find in the 10K on the face of the balance sheet, but internally, that's what we call the receivables that represent the total IOUs in terms of what your customers owe you. So we have the accounts receivable, which is an asset that increases in the same amount as the sale that is recognized. At the same time, the firm has a reasonable expectation that some of these accounts receivable are not going to be collected. And if you have watched the prior video on loss accruals, then you know that we have an asymmetric recognition of gains and losses. Gains we do not recognize until they actually happens, but losses we recognize when it is probable that they're going to occur, and we have an ability to reasonably estimate them. And if you haven't watched the video, I recommend that you go and watch. It's a short video that sets up the intuition behind the specifics that we're going to do here. Whenever the firm does credit sale, it has a reasonable expectation that some customers, they're not going to be able to collect these receivables from. Now, the firm cannot identify which specific customers are not going to pay. If you could, you probably wouldn't do business with those customers, but you have the ability to estimate it overall. So the firm is going to record the expected collection losses during the same period when they're actually doing the credit sale. So this is going to be forward-looking. The loss hasn't occurred yet, but we know that it's coming. We know that there's some probability that some customers are going to default. We're not going to wait and see which of the customers default. We will recognize this loss in expectation. So how do we do this? We're going to fill our loss accrual bucket. This is not a cash bucket. This is not us saving for a rainy day. This reflects a bucket of bad news. When we know the loss is coming, we recognize this expectation. We hit our income statement and our balance sheet. We create a loss accrual. When we look on the balance sheet of a firm that has accounts receivable, they must be reflected in the amount that the company is expecting to collect. So the company cannot just tell us the total IOUs that are outstanding. They need to make sure that they incorporate the expectation that some of those receivables will not be collected. So what we see on the balance sheet are net accounts receivable. That word net is just a general term that means something minus something else. We have previously talked about net assets. We've previously talked about net income. So again, net is just kind of a general preface. So net accounts receivable specifically means that we start with gross accounts receivable. This is contractually what our customers must repay to us based on the work that we have done. And we offset it with an allowance for doubtful accounts. So the allowance for doubtful accounts is a contra asset, and it is equal to the estimate out of the total accounts receivable. How much do we not think we're going to collect? We have an asset, which is the parent account, and we have a contra asset, which is a child account, which essentially offsets what the parent is doing. Why do we call this allowance a contra asset? Why are we complicating our life? Why can't we just call it a liability? The nature of contra accounts is that they don't exist except that their job is to offset some parent account. So here, the only reason we have an allowance is not because it's kind of a independent liability on its own, but because the job of the allowance is to offset the gross accounts receivable. The gross accounts receivable is the total IOUs, and the allowance says, yes, but some of those IOUs I don't think I'm going to be able to collect, so let's estimate that, and its job is to offset it for the purposes of net presentation on the financial statements. For Verizon, for example, if we go on the balance sheet, we can see that the labeling is accounts receivable net of allowance. So it tells us that the net accounts receivable at the end of this specific year was $25.429 billion. But this was net of allowance of $733 million. Even though the company doesn't tell us the gross accounts receivable, we can back it out. We can say, well, if we add back the allowance, that means that overall, in terms of what Verizon's customers owe to Verizon, it is a little bit over $26 billion. But Verizon has estimated that they will not be able to collect $733 million. So we subtract that for the purposes of net presentation on the balance sheet. Let's talk about how the company estimates the uncollectability. The firm must estimate the ending balance in the allowance account based on something called the CECL model, the current expected credit loss model. Even in the name itself, you see the word expected. So by nature, it is forward-looking. We're asking the firm to think ahead in terms of how much of the accounts receivable they won't be able to collect. There is no specific methodology that's prescribed here in terms of how the company must come up with the estimation, because this is very much dependent on what is normal for an industry, what is normal for the firm, what are the factors that predict uncollectability of receivables for your specific situations. But there are some generalities which are helpful for us to understand. First, this approach relies heavily on your specific historical experience. What have you seen in terms of defaults previously from your customers on things like customer composition? We know that individual customers tend to default more than small businesses. Small businesses tend to default more than large businesses, etc. Economic trends, so depending on the macro situation and whether overall defaults are more or less likely. Again, it doesn't identify a specific customer. Rather, it relies on statistical probabilities in terms of the risk factors which are likely to predict levels of default. And companies do differ in terms of the granularity of how they're predicting the default. Some do it for specific accounts, kind of what the probability of default is. A lot do it by account groups. So separately do it for East Coast customers or West Coast customers, for example, if you have a different expectation of default. Or very commonly, and what I'm going to show in the next couple of minutes, is grouping your accounts by age and predicting the default rate as differently for accounts that are very young or that have already been outstanding for some time. Let's go through an illustration of the aging of accounts receivable methodology. Here we see what the credit department of this firm has put together in terms of the aging schedule of accounts receivable. They have grouped all of their customers into the buckets in terms of how long the receivables have been outstanding: 1 to 30 days, 31 to 60 days, 61 to 90, or it has been outstanding for more than 90 days. And then what the credit department has done is said, well, we have an expectation that the receivables which are younger have a better probability that they're going to be collected. So maybe for these receivables, we only expect 3% uncollectability. As time goes on, as the receivable ages and we haven't yet collected it, we are increasing the probability of default up to the point that if we look at the bucket of the accounts which are over 90 days, we say, well, there's a good chance, there's a 20% probability that we won't be able to collect it. Again, these estimates are going to be firm specific. This is something that the firm needs to come up with based on their historical experience, based on what's happening with their customers, with the economic trends, etc. But at the end of the day, they will then multiply the total, the gross accounts receivable in each bucket by the estimated uncollectability. And then they will sum the amounts in this bottom line here. And the conclusion will be, well, we have gross accounts receivable of $138,000. This is what all of our customers that we have here, this is in total what they owe us. But of that, we don't think we're going to be able to collect $8,940. So this is a balance of our asset gross accounts receivable, and we have just calculated the balance of the allowance that we need to have to accurately reflect that we will not be able to collect some of these accounts receivable. So this needs to be the balance in our contra asset. If the aging schedule tells us that the balance allowance needs to be $8,940, how much do we add to our bucket of bad news? How much do we add to the loss accrual? Well, that depends. That depends how much is already in it. If our loss accrual bucket is completely empty, if we have not yet at all prepared for the possibility that some of these receivables are going to default, then we would need to add the full amount to it. We would need to have expense of $8,940 to fill out our loss accrual bucket. But let's suppose that before we come to the end of the period for this company, the allowance is not at zero. The balance of the allowance is $2,100. And I'm just coming up with numbers here for the purposes of illustration. So the allowance right now is $2,100. The aging schedule tells us that the allowance needs to be $8,940. What are we going to do? We're going to fill up the bucket for the difference. So what we really have calculated here is the income statement effect. We are going to recognize an expense on the income statement, and most commonly it's called the bad debt expense, but we could see wording such as provision for bad debt, provision for doubtful accounts, provision for uncollectible accounts, and that reflects the amount which need to be added to the allowance in order for it to get to the correct balance. Here, our bad debt expense needs to be $6,840. How did I calculate it? Well, the aging schedule says that the allowance needs to be $8,940. The allowance right now is only $2,100, so we are short. This is how much we need to add to this loss accrual. We're going to do that by recognizing the expense on the income statement. That, of course, reduces our profitability. That reduces our retained earnings for the period that we recognize this. And then we're going to increase the allowance. Keep in mind that the allowance is a contra asset, which means that it belongs in the asset group, but it works against the assets. All of the dynamics in terms of the signs are the opposite. So when we increase the allowance, we're going to show it as a reduction to our total assets because our contra asset is going up. It's draining the total assets that we have. So this will be done in expectations. Remember, we haven't actually indicated that any of the customers have defaulted yet. This is just us looking at the receivables that we have outstanding at the end of the quarter saying, I don't think I'm going to be able to collect all of them. So I need to make sure that I recognize these bad news that are probable and expected in the future today in anticipation. Eventually, the firm will identify which customers are actually in default. How firms identify whether customers in default differ. Sometimes it could be that literally the customer is in bankruptcy, so we know we're not going to be able to collect from them. A lot of times it's just an internal rule that if we haven't collected a receivable for 180 days or 365 days or something like that, we consider it to be in default. However, the firm does it when it happens, when the company makes the determination that a certain account is in default, we are going to reduce our loss accrual. So this allowance that reflects the expectation that some customers are not going to pay is going to be reduced when we identify the specific customers which are in fact not paying. And we know that if we have estimated correctly, then we're not going to have additional impact on net income. We're not going to have additional impact on net assets. Here we're talking about receivable write-offs. So if we know that a customer is in default, we're going to remove the receivable from the books entirely. So the gross accounts receivable, the parent account, will be reduced. We're also going to reduce the contra asset, which is our loss accrual, because again, that's exactly the situation that we were preparing for, and now it's occurring. Let's suppose that the company determines that it cannot collect $1,000 from a specific CRIS account. Both the asset and the contra assets go down. Notice what we don't do is we have no further impact on the income statement. Why? Well, because we knew some customers were going to default. We weren't sure which ones, but now we do have a customer that defaults. We prepared for it. We already hit our profitability in expectations. We don't need to do anything extra. We're just cleaning up of our books here. Just to reiterate, the determination that a certain account receivable is in default does not have further impact on net income. And also, it doesn't actually impact the balance sheet in terms of the net assets amount. So let's check that. If we think about the company that we're using in this example, the gross accounts receivable went from 138 to 137,000. So we said that receivable is gone. So let's write it off. But the allowance, the contra asset, also went down by $1,000. So in terms of what we show as a net accounts receivable on the balance sheet, that stayed the same. Let's take a look at an example of disclosure of how the company talks about it. So this is the F Corporation. How do they determine the appropriate value of the allowance? They review specific customer accounts, but also they review assessment of collectability of total receivables. So they look at risk characteristic, historical trends, economic conditions, forecasts, etc. They look at both the history as well as what we can do in terms of predicting future conditions, and they think about overall uncollectability. This is kind of the qualitative disclosure in terms of their policy. This is coupled with quantitative disclosure in terms of the details. We have for each year the beginning balance, and then we can see how much they added to the allowance via the bad debt expense. So this is done based on these estimated forward-looking basis. We can see how much they subtracted from the allowance. These are the write-offs, the actual defaults that we are talking about. That's in the deduction column, and that gets us to the ending balance. Let me jump for a second into the SEC filing to show you where exactly I found this information in the 10K. So here we are on the main landing page of EDGAR, the SEC filings, and I'm going to look for VF Corporation right here. On the slides, I have information from several years ago. Let's look instead at the most recent 10K. So if I go to the 10K, there is one that is filed on May 20th of 2026. I could go searching through the table of contents. We know that the benefit of getting familiar with 10Ks is that the table of contents is going to look the same no matter what company you're actually going to pull up. But because we're looking for a very specific item, I'm going to do a keyword search specifically for the terminology that is relevant for me. So I'm going to look for allowance for doubtful accounts. So the first place that we see it is right on the balance sheet. So accounts receivable are reported less of allowance for doubtful accounts. So we can see that here. I can see that in the discussion of accounts receivable, we have this qualitative disclosure in terms of how allowance is estimated. We have another footnote on the details of accounts receivable. We have a little bit information on the composition of specific accounts receivable, and we see the same allowance here that we saw on the balance sheet. And finally, we have the same schedule that I showed on the slide. This is typically called Schedule 2, Valuation and Qualifying Accounts, and it's towards the end of the 10K. You can see that it is on one of the final pages. It has information about various valuation accounts. We're specifically interested in allowance for doubtful accounts. We can see the dynamics here for the year ended March 2026. Here's the beginning balance. We see the charges to costs and expenses. So they don't label it the bad debt expense, but that's exactly what it is. This is the bad debt expense, 9480. The deductions are the actual defaults that they have experienced, so 17369, and that gets us to the ending balance. Let's summarize what the dynamics of allowance are for the firm as time goes on. Let's say that we have a brand new firm. They make their very first credit sales and they recognize an allowance at the end of the period that reflect the expectation that some of the outstanding receivables are not going to be collected. Because this is a brand new first quarter for them, they didn't have anything in this bucket of bad news, so they're going to recognize a large bad debt expense to reflect the allowance going from 0 to some number which is indicated by their aging schedule or another methodology that they follow. And then we have the beginning on the next quarter, and their allowance is at a certain level. And during the quarter, they have a write-off. During the quarter, they identify a certain customer who has defaulted. That brings down both the asset and the contra asset, the allowance. And then the allowance is now at a lower level. Let's suppose they have another write-off, and they get to the end of the quarter. At the end of the quarter, they will redo the exercise. They will again create the aging schedule. They will again calculate what the allowance balance should be, and that will allow them to see how much to top it off. They will recognize the bad debt expense that gets the allowance from the lower number that it is currently sitting at to the value that it needs to be based on the aging schedule. And then again, throughout the quarter, they will have write-offs, actual bad news materialize, get to the end of the quarter, recognize the bad debt expense to bring the allowance to where it needs to be. So you see a pattern here that throughout the quarter, you have bad news that actually happen that lead to the loss accrual bucket getting lower and lower, get to the end of the period, top it off with an income statement charge, and repeat that over and over. What happens if the firm didn't correctly estimate the customer default? Possibility number one, the firm didn't anticipate the number of defaults, or they didn't anticipate a specific very large default. And what happens is they do not have enough bad news in the loss accrual bucket. So in that situation, they will need to hit their financial statements. So here's an example. Leapfrog Enterprises had an allowance for doubtful accounts at the end of the period of $659,000. But in 2012, a single customer that happened to be a very large customer for them has entered into bankruptcy, so they considered that to be a default, and that led to recognition of a bad debt expense of $3.1 million. This was a situation where they did not have enough of an expectation of bad news earlier, so they did not hit their profitability enough earlier. So when we have the actual bad news materialize, there is no sufficient accrual. So in this situation, they need to make up for it. So they need to recognize the bad debt expense that reflects the shortcoming and the failure to anticipate this previously. We could have an opposite situation as well. Harley-Davidson at the end of the second quarter 2012 started with an allowance of $122 million. At this point, their allowance is too large. The customers are not defaulting, and this is kind of a result of several periods of being overly pessimistic. So when they make the determination that the allowance balance is now too high, it doesn't accurately reflect the expectation of uncollectability in the future, what they did is they recorded a negative bad debt expense. So instead of a charge that decreases the profit, which is normally what bad debt expense do, they did a reversal. They actually did a profit increasing adjustment to make up for the fact that they reduced their profits too much in the past in expectation of really bad news, but the bad news are not quite materializing to the same degree. This was a basic introduction to accounts receivable, the asset, and allowance for uncollectible account, the contra asset that reflects how much of the accounts receivable we don't expect to collect in the future. I hope you enjoyed the video. Please like, subscribe, share it with your colleagues and friends, and I'll see you in the next one.